Hello everyone, welcome back to IPO Results. I'm Katherine. Today's video is one of my favorite. I'm so proud to introduce one of the best agents in this industry, Yosh Mendis, our national partner who brings unrivaled expertise and insight to our team. With vast experience in the fast food investment sector, Yosh has been instrumental in driving significant growth and success for our clients. His vision and deep understanding of the market dynamics make him an invaluable asset, ensuring that our clients receive the highest level of service and the most informed investment advice. Hey Yosh, just say hi to our audience.
How you going everyone? My name's Yosh Mendis. I'm a national partner here at IPO Results. Katherine, thanks for having me here today. I'm looking forward to talking about our booming fast food investment sector.
I'm going to ask Yosh a few questions about fast food, and hopefully this video will help you have a better understanding of this asset class and the market's future. Fast food properties are getting more and more attention. Can you please provide some insights into the fast food growth in Australia?
Yeah, absolutely. Certainly from an investment perspective, fast food has historically been the most sought after asset class in Australia. And that has been the same case for decades. And that hasn't changed coming into this year. Investor demand for this asset it's still at all-time highs. We've still seen a number of investors invest locally and internationally for fast food assets. We've had a number of investors who have bought cross-border, where they may be based in, say, Victoria or New South Wales, buying within Queensland, or Queensland buying even in Victoria or New South Wales. We've had WA investors investing on the eastern seaboard. We do find fast food as an asset class probably has some of the most cross-border transactions out of any asset class. The reason for that is because every fast food asset, irrespective of their location, is exactly the same. So an investor in WA can buy a property in New South Wales, or a Sydney investor can buy a property in WA knowing they're getting the exact same product in a different location. We've also found that over the last few years, a huge influx of investors investing in fast food regionally. The reason for that is that there's a tightening of metropolitan product across Australia, which is making the drive for investors in buying a comparable or equal covenant in regional areas. What it's actually done to those regional assets and investments there is it's actually compressed the yields for fast food in regional town.
Why is the fast food market considered recession-proof and a strong long-term investment?
Yeah, it's a great question. I know that from a historical perspective and how investors look at that asset class now, when you actually look at the business fundamentals, fast food, everyone needs to eat. Particularly within varying different climates, they're affordable food options. Everyone can afford fast food. The other transitions that a lot of these fast food operators have had over the last 10, 20 years is obviously the drive-through model, which has always been a very successful structure for them, but also the influx of being able to do delivery through their own delivery sources or other third-party sources like Uber Eats, has allowed them to get to a much larger consumer base at a very fast pace. We're finding a lot of these fast food operators have really seen significant growth even post-pandemic, where we had a number of stores were open during these periods and they were considered essential service. And those businesses thrived and survived through their drive-through. And what we've seen from that is an influx of investors who see the resilience and strength in that asset class, which has continued to drive investor demand. From an investment perspective as well, irrespective of what is happening in economic climates, fast food options are always considered an affordable consumer base. So when people aren't going to all the nice restaurants, they're traditionally going to the likes of your KFCs, your Hungry Jacks, your Guzman Gomez for dinner, which is driving that demand and certainly the consumer sales for a number of these fast food operators.
I've been involved in some of the fast food transactions, and then I know what happened in this market. Can you please just share some experience and some stories about the recent sales?
Absolutely, there's a number of transactions we can discuss. For us, we're very fortunate at IPO Results. Fast food is one of our major asset sectors, and we have some of the strongest market share nationally within this sector. Over the last few months, we've seen a number of transactions within the fast food space. We've been very fortunate enough that we sold most of the McDonald's investments across the country. Particularly in the last 12 months, we've seen some phenomenal yields being achieved for those assets. We sold a McDonald's at Unanderra at a 3.51% yield. We sold a McDonald's in Cardiff at a 3.25% yield. We sold a McDonald's in North Rothbury soon after that at a 2.97% yield. It is a pure example of the investor demand for those assets. We've seen an absolute influx of investors coming from interstate and internationally to buy these asset classes. the way that investors look at these is like bond-like investments. They are more comfortable in buying fast food than leaving the money in the bank.
Yeah, true.
Even when yields are, as low as in the threes. But people look at them as absolute safe havens with consistent growth and long-term leases to some of the world's largest tenants.
Yeah, same as like Helen. She just want fast food.
Yeah,
she just focus on that sector. And then how about the inquiries for the properties?
Inquiries across fast food are generally very strong. For example, we had more than 300 inquiries across the McDonald's at Cardiff. And traditionally when we list a McDonald's, we can see inquiries in the 300s, 400 people. It's just one of those asset classes that everyone wants to own. They are very rare. People who own these assets do not sell them. We feel very fortunate to have sold the ones that we have, but often when we sell that asset, very rarely do we get that asset again to sell for another 10 years. It could be longer. I sold a KFC at Dulwich Hill some time ago. That owner had owned it for 35 years. I sold a KFC in DY some time ago and the owner had owned it for 33 years. This asset class is probably one of the most tightly held asset classes in the market. You traditionally see investors who own other fast food assets buy other fast food assets. It is an ecosystem where when people own one of them, they can't help themselves to buy more.
I understand larger investors are also looking into fast food. Can you please share any experience or case studies?
Larger investors are certainly looking into the fast food sector. We've seen a number of investors diversify into the fast food sector, notwithstanding the fact that we had larger investors buy freestanding fast food investments, but we've sold a number of multi-tenanted fast food assets. As an example, we sold a fantastic asset in South Windsor, which was actually a childcare centre, a Hungry Jack's, a Guzman Gomez, an Porto and a Subway all on one asset. That investor bought that property for $22.2 million at a 4.98% yield. In addition to that, we actually also sold the Robina Central Super Shopping Centre in Robina in the Gold Coast. That property was anchored by an Ampol, Aldi, Guzman Gomez, Starbucks, Medical Centre. We sold that asset for a 5% yield, which shows you that this type of investor demand from entry-level investors all the way up to your high net worth and ultra high net worth private investors.
What can we expect from you in this current portfolio?
We saw exceptional results in our most recent campaign, including $131 million worth of real estate sold over 3 days. This included 31 properties which were sold under the hammer with a clearance rate of 72%. Within that portfolio, we saw some exceptional fast food investments, including the freestanding McDonald's at Warrawong, which we sold for $12.85 million at a yield of 4.10%. We sold a freestanding Hungry Jack's investment for $7.6 million at a 4.01% yield. We also sold a Starbucks for $6.2 million at 4.65% yield and an Porto freestanding drive-through investment for $5.1 million at a 4.8% yield. In addition to that, we sold a Liquorland and Domino's at Warrawong for $6 million at a 5.4% yield. In total, the Warrawong fast food and liquor portfolio sold for a combined value of $37.75 million with a blended yield of 4.47%. In addition to that, we secured an exceptional result for a KFC in Bundaberg at $4.55 million at a 4.87% yield. These results continue to exemplify the exceptional investor demand for fast food investments across the country.
What are the key market insights for fast food, such as McDonald's and Hungry Jack's, specifically in Australia?
Yeah, so we've had a big landscape with fast food. It is going through a big growth pattern of new brands, new businesses. We've seen a huge influx of growth in a number of those networks for a lot of those fast food brands, but also an introduction of new brands coming into the network. Some of these more household names like your Hungry Jack's, your KFCs and your McDonald's have dominated the fast food industry space for a very long time, and they continue to do so. But they are now starting to get more competition from a number of new brands developed from inception within Australia or coming from other overseas locations like America. We've seen brands like Guzman Gomez, El Jana, Frango's, Wendy's, a Porto, a Starbucks, Taco Bell. All these brands continue to grow and aggressively hunt new locations to continue to expand their store network.
You just achieved a great result in selling the GYG in Tamworth. Can you please discuss the recent IPO and what this means to the market?
Yeah, absolutely. So We did secure a strong result for the GYG in Tamworth. We sold that at 5.5 million at a 4.7% yield. It follows a run of other assets that we've sold, including the Guzman Gomez in Unidera, which we sold for 4.45%, as well as the GYG in Nara, which we sold for 4.55%. The brand Guzman is becoming a much more of a household name, and investors' confidence around them is very strong. The IPO recently has been an amazing journey for them. It's been one of the most successful IPOs that we've seen in recent years, and it's really driven the backing of that brand for investors even further. I think there's a long growth journey that they're about to go on, which is going to be exciting, but there is going to be an aggressive number of new stores that will be built given the influx of new capital.
What are some other emerging brands in Australia now?
There are a number of new emerging brands in Australia. So we're finding at the moment the competition within that fast food investment sector continues to grow. We're seeing a number of new brands come into the market. Obviously, Guzman Gomez has grown significantly in a fairly short period of time. We've seen brands like Eljana, Frango's, Wendy's, all enter the Australian market. Particularly brands like Wendy's and Taco Bell, which have all come from America. We're certainly seeing a push from those brands into the Australian market space. I think there will be a number of other brands that we'll see coming from international locations as they strive for new markets. And we'll see a number of new brands in America come to Australia.
Can you please explain the lease structures most commonly used in fast food?
Yeah, sure. So in fast food, there's two most commonly used lease structures. Now that's the direct lease, where the tenant actually leases the building and the land from the owner. There are many benefits of that lease structure where often you have brand new purpose-built facilities to a lot of these fast food operators' latest specification designs. Often you get significant depreciation benefits on these buildings, and it is very highly sought after by investors. The alternative lease structure is the ground lease structure. Now, fast food, amongst most of the asset classes in the market, is probably the one market that utilises the ground lease structure more than others. We're finding them rarer and rarer in the marketplace. They are more capital intensive for tenants, as they actually lease the ground from the investor, and they build and maintain the building. Often these rents are a bit lower than direct leases, but investors love the ground lease structure because they're seen as absolute bond-like investments. The tenant will lease the ground from you on a long net lease structure. They often will pay all the outgoings. Any repairs and maintenance on the building, including structural repairs, is actually on the tenant. So for owners, a lot of these people who buy these McDonald's ground leases or Taco Bell ground leases or KFC ground leases, often they'll buy an asset and not look at their asset for the next 20 years.
Very easy management, yeah.
Very easy to manage. It's certainly a preferred option amongst investors, particularly entry-level investors or newer investors into the commercial space. It allows an investor who is traditionally a residential investor to buy a fast food asset, one that they know and understand very easily, given the consumer base for that investor. Everyone's been to a KFC, everyone's been to a McDonald's, everyone's been to a Guzman, so it's an easier understanding for investors moving into different markets, and particularly when they're moving to commercial for the first time. The ground lease structure gives us something that there's very minimal management and very low risk.
How do location and supply factors impact this asset class?
Yeah, amongst fast food, and this is probably prevalent for another number of asset classes, but for fast food particularly at the moment, location and supply is so important. At the moment, locations, fundamentally when you see a fast food asset, and why I enjoy selling them and why investors enjoy buying them, fundamentally if you even strip back thinking about how, big global brand which is leasing your asset, fundamentally your lands are very strong land holdings in the sense that they're very highly accessible, they're often main road or highway locations. Fast food approvals require high traffic locations but easily accessible land holdings, and they're the land holdings that you want to own. They're very adaptable and very difficult to replicate. At the moment we're finding, given the cost of land and construction, the supply of new stores coming to market or coming to network chains is getting harder, and it's creating a lot more competition for these spaces that they currently occupy, which is driving rents, but also the cost to construct these assets and the cost of land. Tenants are having to pay more for these properties to be feasible for developers or even tenants to be building these sites themselves.
Thank you for sharing your experience and insight with us today, and good luck on all your properties in this current portfolio.
Yeah, thank you. It was great to speak to you today, and thanks for having me.
And thanks for watching, and that's all for today.